versus the supply that I mentioned earlier. So we're going to compare that to see how does this compare to the Malaysian companies. We've got the Malaysian asset mix over here. And as you can see, they're invested far more traditionally, like any other insurance companies, like the other insurance companies across the world, in low risk assets, which is Sukuk. So more than 50%, 55% actually in Sukuks, another 14% in cash. Add those two up, 70% of their asset allocation is in low risk, highly liquid, good quality assets. And what's interesting, you can see the real estate over there, only 1% relative to the 20% in the Middle East. So quite a contrast that we see here. And what's even more surprising is that the Malaysian Takaful market is predominantly a family Takaful market. 80% of contributions are family Takaful, and therefore long-term in nature, whereas in the Middle East, the majority, about 80-90%, is traditional P&C or health insurance. So the tail in the Middle East is much shorter. The tail in Malaysia is much longer. And what that means is that the Malaysian companies actually have more headroom and more bandwidth to invest in illiquid assets, whereas the Middle East companies should, in theory, have less bandwidth, less allocations to illiquid assets. But the opposite is actually happening. The Malaysian companies are not allocating a whole lot to high-risk assets, even though they have the bandwidth, they have the headroom to do so because of the duration of their liabilities. Whereas the Middle East companies are still fascinated by these highly liquid, highly volatile assets. So why is this the case? Why do we see this divergence? One of the common arguments that we hear from Takaful companies when we speak to them is that there's not enough local Sukuk for them. A lot of the companies in the Middle East are single market companies, so they're domiciled in the UAE and they only write business in the UAE, or they're domiciled in Bahrain and only write business in Bahrain. So they say that we have local liabilities and we need local assets to support them. And they say that there isn't enough Sukuk available locally because the majority of Sukuk is being issued in Malaysia. And it's true. That is partially true. 50% of all Sukuks are being issued from Malaysia. But that's only partially true because that's not to say that there's not enough Sukuk being issued in the Middle East or in the GCC. As you can see from the graph here, there's more than enough Sukuks being issued in the GCC, in Saudi Arabia, in Qatar, Bahrain, Indonesia, Kuwait, etc. And they're more than sufficient for the needs of Takaful companies. For example, in the UAE, gross technical reserves for Takaful companies, so this is gross, not net, gross technical reserves for Takaful companies add up to about $1.5 billion. In terms of Sukuk outstanding in the UAE, there's $34 billion. So there's more than enough supply for them to purchase into these Sukuks. In Bahrain, for example, total gross Takaful reserves are $150 million, whereas the supply of Sukuk is $8 billion. So again, more than enough Sukuk available for Takaful companies to invest in. Just mind you, this is for direct Takaful companies, does not include the re-Takaful operations. So the argument that there's not enough local supply, it doesn't really hold up. I think there's more than enough supply to meet the needs of these Takaful companies. So again, why are Takaful companies hesitant to invest in Sukuk? Well, the reason is because they mirror their conventional counterparts. They compete with them in underwriting. They use the same strategies and they use the same pricing. They go after the same business. And the same is true of their asset mix. They invest pretty much similarly to their conventional counterparts. So this graph basically shows the composition of Takaful companies versus their conventional counterparts in the Middle East. Now, Takaful companies slightly more liquid, have a bit more cash on hold. But I think what's more interesting is the fact that they both invest heavily in real estate. And there's this fascination in the Middle East with real estate. And there are good reasons for that. These investments have made money for their companies. So a lot of companies, conventional or Takaful, actually make more money from their investment returns than their insurance returns. And from a credit ratings perspective, we consider that to be a concern. An insurance company should make money from its insurance operations and use the float in a very low risk strategy. But you can see that there is a fascination across the market, not just Takaful, but amongst conventional, to invest in these highly volatile, highly liquid assets. Now, one of the other reasons why there is this fascination with real estate and equity is the fact that a lot of the boards of insurance companies, so insurance companies, both conventional and Takaful, are not run by insurance specialists. They're run by either real estate businessmen or people who have their own holdings in real estate. So they understand real estate a bit better, and that's why they want to invest in real estate. Whereas if you were to compare their board of directors to the board of directors across the world, we would say that their insurance expertise is somewhat limited, and therefore that drives some of this asset mix. Now let's dig a bit deeper, because we're looking at consolidated views of the Takaful companies. But the truth is that under Sharia law, you obviously have to have two separate funds, the shareholder fund and the policyholder fund, and their asset mixes will diverge, or should diverge. And so this is the analysis between the two assets, the two funds, and it's true, there is a diversion. The policyholder fund is more liquid in theory, so 56% are in cash, another 21% in sukuk, so fairly about 70%, 70 to 80% is in highly liquid assets. But again, there's still this fascination, almost 16% still in real estate. Now remember, the policyholder fund is specifically there to pay claims. That's its only objective. The shareholder fund can be invested in more high-risk assets because they can chase a bit more yield, and those are not pledged assets, whereas the policyholder fund assets are specifically pledged for policyholder servicing. And yet they still contain high-risk assets, highly liquid assets. And remember, Middle East insurance companies are traditionally P&C companies, general takaful, or health, which means they have short duration liabilities, short tails, and they need highly liquid assets, but they're still holding these illiquids in their policyholder fund. Now, the quality of the asset mix is important, but the other question is, are there enough assets in the policyholder fund to begin with? In theory, there should be, because there's a qard hasan, and if there is a deficit, either an actual deficit, a cash deficit, actuarial deficit, accounting deficit, what have you, most regulations will now mandate a qard hasan to ensure that there's sufficient assets or sufficient capital to support the policyholder liabilities. Our concern has always been that the qard hasan is not a real loan. It's actually an accounting transaction. And no funds are actually being moved around. And what our view is that it's just an accounting entry where you create a receivable and a payable, a debtor and a creditor. And if actual funds were being transferred, then in theory, there should be enough assets to support the policyholder liabilities. Let's see if that's true or not. And this is a worrying graph, in my opinion. So we've done an analysis of the Takaful companies in the Middle East, and if we rebase their net reserves, so this is net, not gross, so we remove their reinsurance recoverables from this. So if we look at their net reserves, case reserves and UPR, and we base that at 100, then there's an actual deficit in the assets that they're investing in of almost 32%. This is worrying. It means that of the liabilities, of the net liabilities that Takaful companies are holding, they only have assets to cover 70% of those. Now, some of those, that 70% is also made up of real estate, which we don't consider fully available because it's not highly liquid. It cannot be sold overnight to service policyholder liabilities. So if we just look at liquid assets, then it gets even worse. You can see the liquid asset deficit is almost 50%. So if those liabilities were to be called in immediately, there would be a 50% deficit ab initio, almost overnight. And that's a very worrying trend. And what that means to me, at least, is that the qard hasan is not being treated as a real loan. It's not actual funds being transferred between the two funds. It feels like just an accounting transaction, and that's an area of concern. In fact, of all the companies that we looked at in the Middle East, only 2 companies had assets sufficient to meet their policyholder obligations. I won't mention their names, but they're the ones that have surpluses built up in their policyholder fund, and they're the ones who've been making the model work. They're the ones who've been distributing surpluses. So it's no surprise that they have sufficient assets to support their liabilities. What does this mean for a rating perspective? Obviously, we are a credit ratings firm, and we have a number of Takaful companies that we review. We look at companies on a standardized basis. So we put them through our capital model. Which it is a stochastic risk-based capital model called the BCAR, Best Capital Adequacy Ratio, and we standardize it for all companies so we have a comparable result. As far as the cooks are concerned, we treat them the same as bonds or fixed income. So if they're rated, they will be charged according to the rating, and if they're unrated, we will charge them as unrated fixed income. If you have real estate assets, then they will incur high charges because of the fact that they're highly liquid. And then if you're in the Middle East, then these are very shallow market. They don't have a lot of depth, so we have to increase those charges even further for shallower investment markets. Another issue is concentration risk. So obviously, because of Middle East capital markets are already quite shallow, there's not a whole lot to choose from. And then when you put the Sharia restrictions on top, there's not a whole lot left. So conventional banks go out. And if you look at the indexes of a lot of the Middle East capital markets or equity markets, then they're made up of conventional banks. So you completely exclude them, then that means there's not a whole lot left for you to invest in. You're going to end up investing in a bit of manufacturing and a bit of real estate. And that's going to increase your concentration risk. And then as far as your cash is concerned, there's not a whole lot of Islamic banks available for you to put your deposits in. Jordan, for example, there's only 4 banks, Islamic banks you can actually put your money in. So the concentration risk does go up, and we have to increase our asset charges when there's concentration risk attached. Lastly, I'm going to touch on ESG. I'm not going to go into too much detail. I think some of the panel members will be speaking on this in a bit more detail than I will. But there is an overlap between halal investing and ESG. ESG is something that we're taking more and more seriously as time goes by. We have incorporated it into our methodology and our criteria. So we look at it as part of our underwriting. We look at it as part of the investment management as well. And we ask those questions to companies. So it is becoming increasingly important. As far as we're concerned, as far as we've seen, Takaful companies are not really looking at ESG at all at the moment. We haven't seen a whole lot of activity on this. But because of the fact that there is overlap, we do believe that this could change quite fast. Things like ethical investing is already part of Sharia investing. The fact that there's a screening process and there's a governance framework that sits behind asset selection means that ESG integration could be better, could be faster than it would be for conventional companies. So again, I won't take up too much time on this. There are other panel members that could speak more intelligently on this. And that's pretty much it for me. Thank you.
Thank you very much, Salman, for that. May I call upon Maaqil to make his remarks?
Thank you, Iqbal. Don't worry, I'm not going to try to sell you anything today, even though Iqbal says that we're quite expensive. We're not that expensive, don't worry. I've only got one real slide today. So FTSE Russell is the leading global index provider now. We've got around £16 billion worth of assets tracking our indices globally. We offer a very wide range of indices from our global, regional, FTSE 100, which everyone knows, our Sharia index offering, and as well as our ESG indices as well. So a little bit more about the group. We're now a part of the London Stock Exchange Group, which is a huge organisation now, which is more than just the London Stock Exchange alone. We were bought out by the LSE Group back in 2014. We were previously owned by Financial Times and LSE, but we're part of a wider group now. As you can see, we offer a huge range of various activities now as part of the group, and FTSE Russell forms part of the London Stock Exchange Group now. So as I mentioned, we offer a huge range of indices, Sharia compliant indices, and FTSE for Good, which is our leading ESG index series since 2001. So Iqbal asked us to have a very quick look at the relationship between our conventional green and Sharia index. So as I said, I've literally just got one slide to show you. What we've done is we have taken the constituents of our conventional global index. So our developed index contains around 1,400 constituents. So that makes part of our global index. Our Sharia index is around 800 constituents of those 1,400. And our FTSE for Good index is around 1,000. So what we've done, and Iqbal asked us to do, is we've tried to put together a composite index, a pure index, if you will, of the overlap between the FTSE for Good index and the Sharia index, so the common constituents between the two of those companies. As you can see, we end up with around 450 companies which are part of both indices. And the performance isn't too bad, actually. I mean, if you have a look at the orange line there, which is the FTSE Developed Index, that's the main underlying conventional index. The grey line is our Shariah index. The green line is FTSE for Good, which is an index which we've been calculating since 2001. And our simulated index, which we've put together the data for, is the blue line, which performs pretty well, actually. As you can see, I think the performance for most of them are pretty consistent over the last 10 years or so. So what we're trying to demonstrate here is there isn't that perception where you will have to give up some performance if you invest in an ethical and a Sharia way. And I think this simulation demonstrates that, as Iqbal was saying earlier as well. So this isn't a live index, but it's something that shows that what we can do. And we have all the tools and the various analytics that we can generate something that shows that the performance is there and has consistently more or less mirrored our developed index over the past 10 years or so. I think that's it, Iqbal. Yeah. Great.
Thank you.
Yes, so as you can see from there, can we have that slide back? Yeah. You can see that for most of the time, these are running parallel. Sometimes there is some variations. Obviously, for the Sharia indexes, when the banking sector is doing very well and we exclude the banking sector, there will be a dip and so on. But generally, overall, the combined, which get the best of the ESG and best of Sharia, seems to be doing quite well. So I think there is a no-brainer there to think about it. But let's see if we can do even better, and let's go to George to see what he can show us. Thank you.
Thank you, Iqbal. My name is George Latham. I'm the managing partner of WHEB Asset Management, and I'm going to talk about sustainable investing in a broader context. I'm going to talk at a slightly higher level than we've been hearing, I think, to date, but just to put it in context, and then in the context potentially of what it means for Takaful investors. So, as others have shown, the standard disclaimer: this is a fairly high-level, non-product pitch oriented presentation. I represent WHEB Asset Management. We are probably the firm that you definitely haven't heard of today. We are a boutique specialist investor, and the whole business is focused around sustainable investing. We run a single investment strategy, which is a global equity strategy, and it is focused on sustainability from the core, from the very core, and it also defines the way that we run our business as well. I don't know if the term B Corporation or Benefit Corporation is familiar to you, but we are a certified benefit corporation as a company. We are known as a leading proponent of impact investing, and I'm going to describe a little bit about what I mean by that as I talk through the next few slides. But really, our starting point was about 15 years ago when we first designed our strategy. And we came from a background where we inherited a strategy that had started off as an ethical fund, looking at what it screened out. And typically, the negative screening approach of screening out sin stocks or stocks that trip over ethical criteria is the way that this industry had started. But we wanted to reframe this as an investment approach and start off really by thinking about the world that we live in today, the world that we're investing in today, how it's changing, and how we need to position investors' capital to protect that capital and to also position it well to enhance future returns. And so we started to think much more about what we should be investing in as a starting point, as opposed to starting off from what we didn't want to invest in. And so we started to think about what's happening. This quote leads back, this term sustainability, I think, is used very generically, is used without limitations, really. But the starting point, this is back in the mid-'80s, that this rather imposing-looking lady, who was actually originally the Prime Minister of Norway, led what was known as the Brundtland Commission, and came up with this definition of sustainable development, that it is development that meets the needs of the present without compromising the ability of future generations to meet their own needs. I think we need to bear that in mind in terms of the world that we live in today. I was born in 1970. Actually, this slide takes 1985 as a starting point. But in 1970, global population was 3 billion people. It's now 8. At the end of the Second World War, it was 1.5. It's now 8, and by the mid-century, we're expecting it to be 9 or 10. And by the end of the century, we had one of the world's leading gerontologists speak at our investor conference a couple of weeks ago. By the end of the century, we're expecting world population to be 12 billion people. All of those people are looking to attain higher standards of living, and that historically, with the way that economic development has gone over the last 100 years, has been intrinsically linked with higher levels of resource consumption. And we live in a world where resources are necessarily finite and they have become depleted, and the carrying capacity of the planet to be able to support higher standards of living for an increased population has been significantly damaged. So over the period since 1985, global population has increased by 50%, a third of arable land has been lost, and half of biodiversity has been lost as well. So the ability of the planet to sustain a quality of life for a greater number of people has been depleted. And the challenges that we face over the coming decades are significant as well. To tackle the challenges around climate change, we need to achieve net zero emissions by the mid-century. In order to achieve the targets set, the aspirational target of Paris of 1.5 degrees of global warming, science now tells us that we need to get to zero net emissions by the mid-century. We need to process twice as much solid waste. We have exploding interest in greater protein consumption. We need to increase food production by half. And perhaps linked to that, we need to deal with chronic soaring diseases. We have as many people on the planet who are obese as we do have experiencing malnutrition. We have the challenges to face from both ends of that spectrum. And these challenges are really becoming a clear and present